Today on The Dive, we have the founder of wealth research group, Lior Gantz. Lior has been investing since he was just 16 years old and has built several successful businesses, all while traveling the world. He's here today to discuss the FTX debacle, the Fed's next possible move, what major companies laying off thousands of employees means for the economy, Europe's energy crisis, and where he sees precious metals moving next. Hey, Lior, welcome to The Dive.
Thank you for having me.
Yeah, thank you so much for coming on with us today. Okay, so let's start with crypto. There's been a lot of noise in the cryptoverse lately with exchanges like FTX filing for bankruptcy. Has it changed your sentiment over cryptocurrencies?
I think the problem that we've seen is that when you have a situation where in the crypto world, because of the lack of oversight, exchanges can do the sort of actions that regulated exchanges cannot. I don't think the problem is with crypto, because the whole idea in essence of the cryptocurrencies was to take full control over your ownership of an asset. So to most diehard cryptocurrency investors, that would mean holding on to your own keys in either cold storage or otherwise, and keeping it on the exchange has been a topic for years. What happened with FTX is not that the actual exchange was dysfunctional, it was more that their trading firm lost a lot of money, and in order to compensate for those losses, they migrated user funds or the clients' tokens basically and money to the hedge fund so that it can try to recoup those losses before it moves the money back, and people notice that.
Okay, so let's move on and talk about the Fed. The October US CPI came in at 7.7%. What is your outlook on inflation?
Okay, so October came in at 7.7 year over year. What's even more important is that the month over month came in at 0.4. It was expected at 0.6. Now, for those that think that the difference between 0.4 and 0.6 is minimal, just think about it as the difference between 600 billion and 400 billion. It's a 33% below the expectations. And that's the risk of bankruptcies, the risk that companies that are growing revenue but are still losing on the bottom line, that they would not be able to raise more funds to keep on growing. That risk is diminished. The risk of a severe recession with hundreds of thousands of layoffs, perhaps millions, and going into a double-digit unemployment rate, that risk has diminished. And all of that was priced in to what we saw on Thursday and Friday. And I think that is one thing. In my opinion, what we saw was just a small indication that inflation is cooling. I think that you should wait until December, because in December, what's interesting is that CPI comes before the Fed meeting, not like we had in November, where you had the meeting and then CPI. So we can see what comes from CPI and how they react. I think that will start a better trend. In terms of the inflation, I think it will take years for it to cool down back to 2%. And I think that the end of the zero interest rate policy era is upon us. They will not go back to zero rates in this cycle. At least in the next decade, you will not see rates anywhere near that.
What are your expectations for the next FOMC meeting? Do you think that we will see a more aggressive Fed, or do you think that they have to stop raising rates?
As we see what happens with the CPI a few days before the next Fed meeting, if it comes in hot, they'll raise 75. If it comes in at expectations, I think they will raise by 75 and make comments that they're bending the curve on inflation and that they're starting to win the war on it. And they'll encourage, obviously, Wall Street and everyone else to think that we don't need a lot of more rate hikes. And if it comes in encouraging, then they may even do a 50 basis point, but say to investors to really make sure that they understand this is not a pivot and this is not the end. We're going to continue, but there has a trend has started. So it's either going to be 75 or 50, but it's not going to be below, and they're going to keep hammering at Wall Street that they are not pivoting and not U-turning.
From your view, what does a Fed pivot mean and how likely is it?
So there's two terms basically. There's a pivot and there's a U-turn. Pivot is when you do a little turn, so or a 45-degree turn or something. A pivot to me would mean that they either start to raise by 50 or 25, and between a pivot and a U-turn, I think that they halt and they say we're in a wait and see, because I think that within the Fed, you'll start hearing a lot of governors saying, hey, there's a lag. It could be a 3-month lag, a 6-month lag, or a 12-month lag. And because there is such a lag, we need to pause and see, especially because of how frozen the real estate market is. In my opinion, they're not going to cut the next 2 years at all.
So as soon as the Fed stops hiking, how do you think that the precious metals will react?
That's a great question. I think that especially silver will be the big winner of the end of this rate hike cycle. The dollar index, the DXY, it is enjoying a generational bull market that started in 2011. So we are on a 11-year bull market for the dollar compared to other fiat currencies. That's huge because the average one is about 8 years. So that's one thing. Secondly, we've seen it hitting multiple all-time highs. The most inversely correlated commodity in the world to the DXY index is silver. So once we see them, the Fed talking about beating inflation, counterintuitively, what that means is that the inflow towards treasuries will lessen, and perhaps we'll even see money flowing out of treasuries. Money flowing out of treasuries means that the DXY index will go down, and as it go down below 100, that is extremely bullish for silver. In this cycle, when in my opinion, the DXY index is going below 95, perhaps to 90, and I think that will correspond with silver over 40. If the dollar index actually goes below the 90 and into the 80s and into the lower 80s, I think that silver can break its all-time high of $49.50. And this is within a 3 to 4 year span. When it comes to gold, I think that gold has a chance to see about between 2,500 and 3,000. And I'll tell you a few things that are interesting about gold. In 2019, on the 1st of April, gold turned from a tier 3 asset to a tier 1 asset, according to the Bank of International Settlements, which is the central bank of central bank. When they turn it from a tier 3 to a tier 1, it means that they have a mark-to-market 100% collateral on gold. There are only two other asset classes that they allow this to. It's the US dollar and treasuries. So these risk-free assets in the eyes of institutions are really important, because on the day they changed it, gold was trading for $1,291. If you change it from 50% collateral to 100%, it means that you basically believe it's worth double what it is that day. And $1,291 times 2 is $2,582. So even in the eyes of the central banks, gold is worth around $2,600. So in my opinion, it can really extend and go into a huge rally.
One of your wealth reports is titled Gold Enters Generational Bull Market. Is that what you mean? Could you shed some more light on this?
Sure. There are multiple reasons why gold and silver are forming a generational bottom right now, as we're seeing with this rate hike cycle. Imagine what's going on right now. For many years, there was no alternative for investors other than stocks. Bonds were yielding nothing. And when you create that sort of a scenario, you are creating a world where the FANG companies were treated almost like quasi bonds. Wall Street was buying them for the appreciation, plus they were treating their dividend as a bond yield. Because if you can gain even 1% or 1.5% on Amazon or on Apple, then to Wall Street, that is a reason to pay 40 or 50 times earnings for these companies. that is over. Interest rates are going to stay elevated and normalized for years and years. So as you're creating that scenario where stocks are not the only alternative, you're creating a better equity risk premium. And that makes stocks less attractive. And in that world where stocks are less attractive, Wall Street looks for alternatives, just like in the 2000s and just like in the 70s. And that plays incredibly well for gold and silver. And now the world is changing. If you want a reliable source for your commodities, you will need to pay a premium for it. Because if lithium is coming from Latin America and the Chinese and the Americans are both bidding on it, you have to pay more. And that's what I think will happen.
Now, Germany has announced the nationalization of a former subsidiary of Russia's energy giant Gazprom. Do you think that this will impact Europe's energy crisis situation?
I think Europe's energy situation is in a reset. For about 40 years, they've relied on the petrol station of the world, Russia, to supply their net gas and their oil. And I think that's over. Whether or not Putin stays in power or there's a replacement for him, I think it will take a decade or more for the relations between Russia and Europe to come anywhere close to being orderly. And that's why I think that this energy reset is going to take years and it's going to impact Europe big time. They have no reserves.
As you mentioned earlier on in this interview, there's been some major layoffs lately at Twitter, Meta, and recently Amazon. How do you think that this is affecting the economy? Should investors be aware or even concerned about this?
Well, actually, it's a funny question because Main Street and Wall Street look at it very differently. Wall Street loves it because it means that what the Fed does is working. People and companies are changing their behavior. They're moving from a world of let's just grow and grow and grow and develop more products and spend money and try to find new operations into a world of let's sustain our growth and get better margins. So layoffs or freezings, that is exactly what Wall Street wants to see because it means that inflation is coming under control and that we are going to have a balanced out labor market. Main Street and the banking system don't like it, obviously, because less jobs means less activity in the housing market. And I don't have to remind you that 76% of America's millionaires have come from the real estate industry, including the former president. So, I mean, real estate is the backbone of the U.S. economy, and it's in a standstill right now. Mortgage rates are too high for households, and interest rates are too high for levered up institutional buying. So I think that 2023 will be not as bad for Wall Street, but it will be a very challenging year for households and for the real economy and not the paper economy.
So, Lior, one more thing before we let you go here. Where can our viewers go to get more of your commentary?
So we touched on a few subjects, and I created a number of special reports for your audience around these topics that I think they should download and read for themselves. One of them is about the end of ZIRP or zero interest rate policies. They can go to wealthresearchgroup.com/ZIRP. I think that this situation with inflation being toying with us and creating a fake breakout in gold and in stocks, you can check out wealthresearchgroup.com/out. And in general, our newsletter is at wealthresearchgroup.com, and you can subscribe for free on the homepage. It goes out Sunday, Tuesday, and Thursday, and I combine these macroeconomic topics with personal things that I do, investments, etc., that we talk about.
Well, Lior, thank you so much for joining us today and taking the time to come on and sharing your insights with us.
It was a pleasure. Thank you.
Thanks so much for tuning in today. We will be back again tomorrow, so you may want to hit that notification bell so you don't miss out on our next video. Bye.